Welcome to the McKenna School's Personal Financial Planning Lecture Series, first Fireside Chat here at St. Vincent College. My name is Nicholas Racculia, and I'm the director of this series. The goal of the Personal Financial Planning Lecture Series is to provide informative discussions on timely personal financial topics. The goal of this Fireside Chat is to introduce the topic of tonight's lecture. We are joined by Maureen Farrell from CNN Money. Maureen will talk to us about the bond bubble this evening and why you, the investor, should be concerned. Welcome, Maureen. It's great to have you on campus.
Thanks for having me tonight.
Let's get right to topic. What is the bond bubble and why should investors be concerned?
So the bond bubble is really, we've been in a 30-year bond rally, essentially. Since the early 80s, interest rates were very, very high. Over time, they've come down bit by bit by bit. But since the financial crisis in 2008, there's just so much fear over the health of the global financial system that we saw governments, pension funds, mutual funds, individual investors plow their money into bonds, specifically U.S. Treasuries, which is basically seen as the one safe haven in the world. And
A flight to quality.
exactly, a flight to quality, flight to safety. So the price of bonds has gone way up to levels we've literally never seen before, and interest rates have gone down to all-time lows. They've gone up a little bit lately. So and the Federal Reserve has been wanting to keep interest rates low. So they've plowed a ton of money, also about $1 trillion a year they're spending right now. So people are getting worried that it's a bond bubble because rates are lower than they have ever been before. There's more money in bonds, and there's just this sense that, like panics we've seen, whether it was housing.com, the dot-com bubble, I'll talk tonight about, there's even like a Beanie Baby bubble, that there's a sense that at some point there'll be like a switch in psychology and people will get really worried about bonds and the prices will start going down, interest rates will going up, and it will really crush investors' portfolios.
In terms of timing, what do you see as this a burst that will happen over weeks, over months, longer? What is your prediction there?
So just to I'll give you a little heads up on what I'm going to talk about tonight. I think this is going to be a many year. I actually don't think we're going to have the same panic that we saw in housing. I don't think it's going to be a quick shooting up of rates.
Right.
And that's basically because we have the Federal Reserve and they don't want interest rates to skyrocket. It would be so dangerous to the economy. It would just destabilize things so dramatically. So I think investors all over the world, and you and I, we all should be prepared for interest rates to rise.
Okay.
They have to, especially if the economy keeps on getting better. But I think it's going to be a slow tick higher. I think it's going to be happening over many months, over many years. Because if they start shooting higher like we've seen in the last few months, the Federal Reserve can step in and put the brakes on it. I think it's a place where there's more control from our central bank.
Which demographics do you think will be hit the hardest by the burst?
So, I mean, I think it's probably going to affect retirees or people getting near retirement age the most, because I think a lot of people have more time to prepare for retirement. A lot of people have always just seen bonds as a safe haven. You're always going to get paid a steady return from them. And over the last 30 years, people have made money in bonds. That's going to reverse. People are going to start losing money in bonds. So if you have a certain like nest egg for retirement, there's a good chance if you have a lot put in bonds, it's going to start being eroded.
So what are some preventative steps that our bondholders can take at this time?
So, I mean, people should have a pretty well-diversified portfolio, and I would never say that bonds should not be part of a portfolio now. They're still an important part of safety. I mean, we saw the real gyrations in the stock market after the financial crisis. So people should hold bonds, but it's really a time to be scaling back on just how many bonds you hold. Every investment, chief investment officer, asset manager, not every, but a lot, think it's time to scale back. So typically it was seen, and this doesn't hold for everyone, but keep 60% maybe in stocks, 40% in bonds. This is a time where, if that's the theory, I think portfolios should be even more diversified than that. But you might want to switch over to 70-30. Stay in bonds, but you start scaling back. You don't want to be holding as much They've always been seen as the safe, plain vanilla, kind of boring investment, and they're not gonna be. It's gonna be, things are gonna get dangerous, it's not gonna explode, I don't think, but I think there's this thing that your returns are gonna go down, you could lose money in them.
We don't view bonds as dangerous, we view equity as the riskier, but things might be changing. We're just about out of time. Thank you very much, Maureen, and I hope you can join us tonight. If not, we invite you to watch the lecture in our archives.